Okay. All right. So today we want to look at IS one, sorry, IS two. So this IS two is in line with our IFRS training series, where we are going to be looking at different IFRS standards, and then we're going to be using Microsoft Excel to do the calculations. All right. Um, so I will share my screen briefly to start with. I'm going to share my screen briefly. Just before that, I need a brief introduction of myself. My name is Wilson Ezeko. Um, I'm an accountant of profession, qualified accountant, and I'll be taking you on these sessions of the IFRS series where we're going to be looking at different accounting standards, and then we're going to be using Microsoft Excel for the calculations. Okay, so for each of the accounting standards, we'll be looking at examples where we're going to be showing workings and computation, workings or computations. All right, so now I will share my screen. I'll share my screen now so that we can start right away. Okay, just give me some time. Okay, so the screen I'm displaying right now shows the different accounting standards that we'll be looking at. So as I said earlier, this is more of like an introductory class. So where I'll just have to give you an overview of what this lecture on IFRS series will be about. And here I'm just displaying the list of standards that we're going to be considering. And today, of course, what we'll look at is IAS 2. So now just a point to note here that we have IAS 1. IAS 1 has now been replaced by IFRS 18. Okay. Now the presentation of financial statements, which is IAS 1, will be replaced by IFRS 18 on presentation and disclosure of financial statements. Yeah. So this IFRS 18 was published on April 9, 2024 by the International Accounting Standard Board. The International Accounting Standard Board is a global accounting board that that sets accounting standards. Yeah. So this is expected to be effective from January 1st, 2027. But for organizations that want to adopt IFRS 18 in replacement of IAS 1 earlier, they can go ahead and adopt. So you can see we have a whole list of standards here. The last standard before the IFRS 18, of course, was IFRS 17, which is on insurance contract. So the latest one we are having is IFRS 18 on presentation and disclosure of financial statements. Later on, I'm going to give you an overview of what this IFRS 18 is all about, what is expected, for companies that are very known to be quickly compliant. They can adopt these standards as early as possible, even before the January 1st, 2027 date, which is the date at which all companies are expected to comply with the standard. Okay. Now, that being said, so we'll go to the topic of the day. So we'll go to the topic of the day, which is IAS 2. Which is IAS 2. Okay. Now, when we talk about IAS 2, IAS 2 is on inventory. IAS 2 is on inventory. So, and when we talk about inventory, what's inventory? Inventory is synonymous to stock. Inventory is synonymous to stock. But when we say inventory is not just limited to stock. a loan. Now, what I mean by that is inventory is not just really, restricted to finished goods alone. Now, according to IAS 2, inventories are defined as items that are held for sale in the ordinary course of business, in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process, or in rendering of services. Okay, so this standard applies to all inventories except number one, financial instruments, which is in accordance with IFRS 9 on financial instruments, biological assets, which is related to agricultural activities and agricultural produce at the point of harvest, and that is in accordance with IAS 41 on agriculture. Yeah. So now, there are two types of entities for which the accounting for inventories must be considered. And they are, number one, we have the merchandising entities. Yeah. So the merchandising entities are generally retailers or wholesalers with merchandising inventory. So what do we mean by merchandising inventory? These are goods on hand that are purchased for resale. And then number two, for an entity that's, that holds inventory or have inventories. These are entities for which accounting for inventories must be considered. So we mentioned merchandising entities. Number two is the manufacturer. Now, manufacturers generally have three types of inventories, and they are number one, raw materials. Number two is work in progress, and number three is finished goods. Okay. Now, we can explain this as follows. For inventory as raw materials, right? Raw materials are those materials that are used in production process, that are used up in production process or in the rendering of a service. So any materials that is consumed or used up in the production process or in the rendering of a service is referred to as raw materials. Then number two, we have inventory as work in progress. These are resources that are in the production process but yet to be completed. So when we have inventory in the production process but yet to be completed, it refers to them as work in progress. So inventories can take three different forms. We've mentioned number one, which is inventory as raw materials. Number two, which is inventory as work in progress. Now, number three is inventory as finished goods. Okay, inventory as finished goods. Finished goods are items that are held for sale in the ordinary course of business. Items that are held for sale in the ordinary course of business. These are products or goods that has been completed, that has passed through the process of raw material, of being in the form of raw materials to work in progress and finally to finished goods. Okay, now, having said that, we move to initial recognition criteria for inventory. Initial recognition criteria for inventory. Now, the initial recognition criteria for inventory is that inventory is recognized at cost. Inventory is expected to be recognized at cost. I will say that again. Inventory is recognized at cost. Now, in addition to recognizing inventory at cost, we also have associated costs. These associated costs are expected to be capitalized as part of the cost of inventory. All right. So the first thing is the initial cost of the inventory. We recognize inventory at cost, and then all associated costs should be capitalized as part of the cost of inventory. Now, examples of associated costs are transportation costs. I bought a product, at Alaba market, and I need to move those products down to my shop or my business premise. Okay, all the costs that I've incurred on transportation, which is carried inward, is part of the cost of my inventory. Now, number two, Number two is taxation. The taxation is also part of associated costs. And when we talk about taxation, we mean specifically the value added tax. Okay, the VAT that is paid on an items purchased is also part of the cost of an inventory. And number three, we can also make mention of the holding costs. Okay, the holding costs, e.g., the cost of insurance. You know, when you purchase an item from China, for instance, you need to insure those items. So those the cost of insuring those items in transit is also part of the cost of the inventory. It's an associated cost. Number four, we want to talk about conversion cost, and this is also very important. Now, what do we mean by conversion cost? This is the cost you incurred in getting the goods from raw materials to finished goods. You know, in getting the goods in the form of a raw materials, all the costs incurred in getting the goods in the form of raw materials to a finished product is called conversion cost. An example of conversion cost is your direct labor cost, direct material cost, royalty cost, and factory overhead cost. So all these costs form the conversion cost. Yeah. So now, having identified these associated costs, which are transportation costs, taxation, specifically VAT, holding costs, and conversion costs, all other costs should not form part of inventory costs. Okay, all other costs, and I emphasize that again, all other costs should not form part of inventory costs. The only costs allowed are the transportation costs, the conversion costs, taxation, and the holding costs. Now, let's look at the costs that are excluded from inventory. Number one is abnormal wastage costs. Okay, abnormal wastage cost is not part of the cost of inventory. There's a normal wastage cost, there's an abnormal wastage cost. So when a wastage cost is abnormal, you know, it's not the usual wastage cost, then it should be excluded from the cost of inventory. Number two is warehousing costs. An example is the administrative rental cost of the warehouse. Okay, that should be excluded. Then we have the other admin costs, such as salaries, adverts, and marketing, and also we have carriage outward. Okay, so this cost should be excluded from the cost of an inventory. Okay, all right. So we move on from here to look at the subsequent recognition. Now, before I buttress further on the subsequent recognition of an inventory, I would just quickly like to do a recap of what we have discussed so far. First, we have mentioned that inventories are items, you know, that are either in the form of raw materials in the process of production or in the form of goods that are actually being completed or finished. Okay, so the inventories can take either of these three forms. And then we did mention that inventories, you know, there are some entities that keep inventories or that inventories are associated with them. And these are merchandising entities and manufacturing entities. So merchandising entities maintain inventory, you know, inventory as finished goods. Okay, so inventories are stock as finished goods. But for the manufacturing entities, they have inventories in the form of raw materials, in the form of work in progress, and in the form of finished goods, right? Specifically, so some people, they may, you know, the use of the word finished goods is actually attributed to manufacturing entities. For merchandising entities, you can just simply say stock or inventory. So automatically, we know that what you're talking about is finished goods. Yeah. Now, we made mention of the fact that inventory is being recognized at cost. The initial recognition of inventory is at cost, inclusive of all associated costs. Okay, and we identified these all associated costs, that these costs, and then we say that this cost should be capitalized as part of the cost of inventory. And then we made mention of transportation cost as one of them. We made mention of holding costs. We made mention of conversion costs, and then we made mention of taxation. Okay, so those are the four associated costs that we were able to identify. And then we discussed the costs to be excluded from inventory. We made mention of abnormal wastage costs, warehousing costs, and other admin expenses. Now, let's talk about the subsequent recognition. Now, for the subsequent recognition, inventory is expected to be recognized at the lower of the net realizable value and cost. So when you have the cost of the assets and then you have the net realizable value. So which one of these costs is lower? So for subsequent recognition, you must recognize inventory at the lower of the two. Now, what is the net realizable? What's the net realizable value? The net realizable value is simply the selling price of the stock or inventory minus the selling expenses. So when you take out the selling expenses associated with disposing the inventory or selling the inventory from the selling price, you have the net realizable value. In some texts, you will see this to be that the net realizable value is fair value of the inventory minus cost of disposal. Fair value of the inventory is synonymous to the selling price of the inventory, while the selling expenses being synonymous to the cost of disposal. So whatever terminology is being used at any point in time, you just know that when you talk about net realizable value, it's simply the difference between the selling price of the inventory and the selling expenses. All right. Now, so having said all this, we move straight up to looking at questions that we're going to be solving. All right. So if you look at what we have on the board here, we have question one. Question one. Yeah. So this question one, in this question one, I will share my screen right now to display. I'll share my screen right now to display the question so that we can solve, we can look at it together. Okay. All right. So I'm displaying my screen right now. And then if you look at what I have on the board here, we have question, let me zoom this out so it can be bigger. So we have question one, which is, which reads thus: Iseco has the following products in inventory at year end. So you can see the products that Iseco has. And the question says, at what amount should total inventory be stated in the statement of financial position? At what amount should total inventory be stated in the statement of financial position? Okay, so this table that we have here has been brought into the Excel I'm going to share with you right now. So, so you can see. Now we want to get the cost at which this inventory will be stated in the statement of financial position. Now, one singular mistake, one mistake that is common or one can make or an accountant can make in this instance is to sum up each of these products. You can see that we have three products. We have product A, we have product B. Let me zoom this out so it can be bigger. So you can see that we have three products. We have product A, we have product B, and then we have product C. And then we have the quantity in units. This quantity or units, okay? So quantity or units. We have the cost per unit, then we have the selling price, and then we have the selling cost per unit, and then we have the net realizable value. So what some persons might do, or some accountants might do, or which is a mistake anyway, is to multiply this. You want to multiply this by the costs, yeah. So you multiply this by the costs, yeah. So you want to multiply this by the costs, and then here you are saying that you have the total cost, and then here you want to multiply the quantity. Sorry. So here you want to multiply the quantity by the selling price. So you want to multiply the quantity by the selling price. Oh, so sorry for that. That shouldn't be there. So you want to multiply the quantity by the selling price. And then you put all of this down. And then you call this the selling price. Then the selling cost, you want to multiply this by the unit selling cost. And then you have the total here. So, and then you want to do a total for each of them. So the next thing you now want to do is to say, you want to compare this minus this. So this now becomes your net realizable value. Okay, so this is your total cost, your selling price, selling cost, and this is your net realizable value. So what you then want to do is you want to pick this and pick this at the same time. So you're looking at these two, and then you are saying, okay, which one is lower? So you want to pick this. Okay, you want to pick this and say, because this is lower, let me put it color green. So this is lower, therefore the inventory should be valued at cost. Now, if you do this, this will not be correct. This should be absolutely wrong. And the reason why it should be absolutely wrong is because we have three different products. So you're going to consider this product on a case-by-case basis. That means you consider making your selection per product. So it would be wrong for you to choose the total. Okay? It would be wrong for you to choose the total. So what you simply need to do is I'll simply come here and I'll select the lower of this. You know, I have my total cost here. So this is where I have my total cost. Yeah, I have my total cost here. So if I can bold this, give it a tick border, I have my total cost here. And I have my net realizable value here. Okay, so the question now is, for this, these are for each of the products. Yeah, so these are for each of the product A, product B, and product C. So the question now is, which of them is higher per product? So if I want to pick this, I will say equals to 40 and 47, which is higher and which is lower. 40 is lower than 47. So it means that for product A, the cost is lower than the net realizable value. So I'm going to pick the cost. Okay. For product B, which one is higher and which one is lower? The net realizable value is higher than the cost. So I'm going to pick the cost once again. Then for product C, I have the net realizable value to be 17,600 and the total cost to be 18,400. So which one is lower? The net realizable value is lower. So I'm going to pick the net realizable value. Okay. So I'm now going to sum this. Okay, so once I sum it, it gives me 95,100. So 95,100 is the cost of the inventory. It's the cost of the inventory and not 95,900. Okay, so you have to do it on a case-by-case basis. Make the selection on a case-by-case basis and not on the total. So if you look at the options that we have, if you look at the options that we have in the question, you will see that we have option D to be the correct option. And option D is 95,100. Okay, option D is 95,100. All right, so this is a very straightforward and simple, question. Yeah. So we'll look at the other questions again. We'll look at the other question on page 2. Okay. There's some other questions on IAS 2. I think we have like 3 more questions. So after which we discuss IAS 8. Okay. So I'm going to talk about these other questions or solve these other questions in the next video. Thank you.